Hello, this is Jim Hunt for Bramasol's Comply, Optimize, Transform webcast series. Today we're going to focus on revenue accounting and reporting and specifically on standalone selling price. And we're really lucky today to have Julio Dalla, the Bramasol Director of Technical Accounting. And on the other side, on the IT side, we have Jacek Dudkowski, the Director of Solution Architecture and Delivery. So we're going to drill down in. Julio and Jacek, welcome to the session.
Thanks, Jim. Nice to be here.
Thank you, Jim. Nice to be here.
Okay, Julio, if you can start off by maybe giving an overview of how standalone selling price fits into the overall 606 model.
Yes, thanks, Jim. So, Jim, this is, as we've talked about before, this is coming up from Bramasol's #1 topic for revenue accounting, which is standalone selling price. And I think the reason that is because even 5 years after the standard has passed, ASC 606, IFRS 15, is companies still struggle with understanding actually what it is, and sometimes they have changed their methodologies because realize that maybe one of the methodologies is better than the other. And this is why we're going to have this conversation today. Just as a reminder, obviously ASC 606, the new revenue accounting standard, passed about 5 years ago, and a lot of companies have been still finding challenges with adopting the right approach when it comes to standalone selling price. And if you think about it, standalone selling price is a very dynamic piece of the guidance under the 5-step model. So the 5-step model, everybody knows it's a 5-step model of identifying the contract, identifying the performance obligation, and then obviously determining the standard price. Where SSP falls into the model is step 4, which is you allocate the transaction price to that performance obligation. So you've already identified the performance obligation and you've already identified the transaction price. But as we've seen, especially when it comes to the concept of multiple element arrangements, when you go down to T-Mobile or Verizon and you buy a cell phone and they throw in Netflix for free, we all know from an accounting perspective that Netflix is not actually free. From an ASC 606 perspective, we have to allocate some value to that service or good. And obviously the last step is step 5, which is once we allocate the SSP, we're going to recognize the revenue. Jacek, I just wanted to bring you into this conversation. What are your thoughts on this whole overview of the SSP model and where does it fit in from your perspective?
Thank you, Julio. Well, as the IT guy, obviously we're talking about the SAP's functionality to address 606 requirements, and that will be the revenue accounting module. And the revenue accounting module data model follows those 5 steps in sequence. Even for those of us that live in the configuration side of a system, look at the IMG, look at the nodes of a configuration, they actually follow the 5-step sequence. And around the SSP, we'll talk about maybe later in our webcast here about how RAR takes that data or calculates that data and applies it to the data that is created within the RAR module itself. There are certain concepts which make RAR unique but are also very advantageous to use for 606, specifically the separation of the upstream source data, upstream sales data, as well as the RAR data. But I think maybe before we get there, let's dive a little deeper on the standalone selling price, and I think that's, again, back to you, Julio.
Yeah, sure. So, I think I always like to draw readers to the second bullet on this slide, which is for standalone selling price, you're always trying to find what is the best evidence of standalone selling price. So in my example before, I know I am paying, if I had without a subscription to my cell phone, I'm paying, Netflix $15 a month, right? But then, when I'm paying my cell phone bill and they say, okay, Netflix is included, what is the best evidence of that standalone selling price? Is it what I know other people are paying, or is it that I know based on my individual pricing methodology what that price is going to be based on a system of deductions? So I think from my perspective, it's always good to start at the beginning, which is this the best observable evidence? And if you think about what actually is standalone selling price, it's that price at which the entity would sell a promised good or service separately. And if I had one good in my bundle, or I actually had one good in my package, essentially I don't need SSP, because if I sell it for $10, that's the price the customer is willing to pay. It becomes complicated when you have multiple element arrangements. I think Jacek spoke a little bit about this before, and we'll speak about it in the next slide. But really, it's when you have these multiple element arrangements and the pricing for each individual component is challenging to obtain, that is when the need for a methodology for standalone selling price comes into play. So Jim, next slide. So I always love this slide because I think it's a great graphical reference of what we're talking about here. It's a very challenging topic to actually consume, but I think this slide gives a good estimate of what we're talking about here. So we talked a little bit about what we talked about in the last slide, which is it's the observable price. It's the best evidence. And remember, as we go through the SSP concept, we have to remember as accountants and even professionals working for any organization, it's what is best auditable. So for me, when I see best evidence is I know at the end of the year, I'm going to have to give my external auditors my support for SSP. And from my perspective is what can be best supported? So the FASB gives 3 acceptable methods. The first method is what we call the adjusted market assessment approach. So what does that mean? That means that if for some reason, this is an external looking factor. So what does that mean? It means that if I am pricing something and I know what my competition, my external sources are pricing this good for, then the guidance allows me to use that as the standalone selling price. So a good example is if I am selling Coca-Cola for $1.50 and I know the pricing of Pepsi or the other sodas in that different SKU, then that would give me a good identification. Some industries, they publish their wholesale prices, and the question we have to ask ourselves is that best supportable for my situation? The second methodology is the expected cost plus margin approach. This is, as I said many times in our previous webcast, this is the most acceptable, and the answer is why. The answer is because it's the most convenient for companies. Everybody has their individual internal costing, and everybody knows what margins they can sell these goods and services for. Now, just a quick reminder, this is not just the margin that I would like to receive from a customer. So I can't put a 1,000% margin if I know that I will never sell it at that margin. This is a realistic margin, cost plus margin analysis. And the last one is a throwover from ASC 605, the old revenue recognition accounting standard. And basically what it says is, it allows you to use the residual approach. So the residual approach is exactly how it sounds. If I know if I have 2 goods in a bundle, and I know using one of the other methodologies, the SSP of one of those goods, the residual approach is I can use the delta, the difference between the total less the SSP equals to the SSP of the remainder. So that is essentially, from an accounting perspective, how we define the different methodologies for SSP. Now I'll turn it over to Jacek, where he's going to give us some really good insights on some of these methods, some of the practicalities of it, and what he has seen from his implementing these at various projects. Jacek?
Thank you, Julio. So again, looking at this from an IT person's perspective, the business has devised an approach how to calculate SSP and what is applicable to our business. They've talked to external auditors. Now they're asking for the IT team to implement these processes. And we will have to think in the adjusted market approach, If we have external data that we can reach out to, we would need to, at that point, interface to that data, collect that data, bring it into our systems, into our SAP, whether it's directly into the RAR module or maybe into the sales data. So it's a consideration that we need to take in our implementation of revenue recognition using the RAR module. The expected cost plus margin approach is maybe just as complicated, because at that point, one approach is to just go to a business and say, well, tell me the number. However, most companies, what they'll do is they'll look at the past sales and look at that statistically at that data and determine what was the actual realized value and perhaps what should be applied as an SSP. At that point, you need to start asking yourself, how do I look at that data? Is it segmented into different customer bands, into market bands, into size, into product types? However you want to segment, whether it makes sense, allows you to get a much more precise value of SSP and therefore much more applicable value for allocation for that particular bundle you're selling to a particular market segment. And finally, I guess what I would call old reliable, as Julio mentioned, residual approach. The good thing is the RAR functionality from SAP allows you to use the residual approach on on revenue contracts, where that product, just the first two methods just do not apply. It's a saving grace for an IT person if it's allowed, because again, I do not need to know any external data. The RAR tool will just calculate that residual approach, calculate the SSP, and do the correct allocation. As somebody who've implemented RAR in multiple clients, I've seen all of these approaches. The middle one specifically does bring challenges of collecting and segregating historical sales data. And whenever somebody's thinking of that approach, you need to think of what are the tools that will do that. Where those are desktop tools such as Excel, and have folks working on that data and inputting that data directly into either the revenue tool or the sales functionality such as SAP SD, or whether we create automated tools that will segregate data and provide input directly to, again, either SD or RAR. So those are the IT considerations of the various methods of calculating and capturing SSP. And Jim, you can probably move to the next slide.
That's great, Jacek. Thank you for that. Julio, if you can kind of, let's zoom out, look at the overall challenges, and then Jacek will drill down and we'll look at the applicability of SAP RAR for SSP.
Definitely. So, based on our projects and, just looking at the market and what people come back and tell us, I think there are three main areas for challenges when you look at SSP. The first one is the highly variable or uncertain pricing. Obviously, the more uncertain your pricing is, the harder it is to come up with an SSP, because the nature of the SSP is you're supposed to have a value that is reliable, that actually, you can use and be supported by your, by your external audits. More importantly, though, there's the highly variable one. So as we go into this analysis, most companies tend to update SSP on an annual basis or biannual basis. So it's really important to understand, if you are in a high price sensitivity environment where your prices are just moving a lot, then you have to ask yourself, if I only update my SSP once a year, is my SSP correct? Especially if I have a lot of moving prices throughout that period. The second piece is, how do you actually establish a range? So what we've seen in practice is, most companies, what they do is they have an SSP, and then they basically say, within this tolerance range, some companies use 2%, some companies use 10%. And again, that relates to, number one as well, which is, how fast are these prices actually moving or changing up or down will determine. So if you set a 2% tolerance range, and every time your system kicks out most of your orders because they are outside of the range, we have to ask ourselves, have we set the range too narrowly? And lastly, when it comes to multi-element arrangements, especially when we're selling software or software goods and services, what you find is, you're buying a subscription to a piece of software, or you're buying software, and usually companies may throw in things like PCS, post-contract support, and those are some of the more challenging areas because you can pretty much have a good pricing strategy for your your main software. But when it comes into PCS, it comes into a lot of questions about, well, what's the real value of that? Some companies price it in at zero. Some companies have a price for it. But sometimes, especially from an audit perspective, these things can be challenged. And I think the advice that I would give from an accounting perspective is whatever methodology you're using, just make sure that we have good support. It makes logical sense, and we can support those analyses, because at some point, people like myself will be handing over, hey, what's the best evidence? What's the best support we can give to our auditors? So with that, I'll turn it back over to you, Jim.
Okay, great. And Jacek, if you could, in the few minutes we have left, kind of do a drill down and talk about how everything we just talked about with SSP relates and applies in the SAP RAR world.
Thank you, Jim, and thanks, Julio. Again, the IT perspective, we're talking about application of SAP tools in the portfolio on top of probably an existing SAP sales and financial applications for an integrated end-to-end solution. The design principle around SAP RAR is that, and I'm going to go straight to the last bullet point, is that decouples the sales transaction from the revenue contract. The term revenue contract is defined by the 606 guidance, and RAR creates a separate business object around that, a separate system object actually around that, with its individual line items and performance obligations. Why is that important? Because now I can capture SSP from an external or upstream source and capture that directly into my RAR contract, rather than needing to feed that into existing systems and tools that manage the sales transactions. I don't necessarily need to change those tools to do so. I am also now allowed to perhaps maintain that SSP directly on the revenue contract within the RAR UI, the context of the tool itself. My revenue team can work with the data that they have on hand and maintain that data directly in the RAR system on top of the revenue contract. Again, I do not need to disturb my upstream sales processes or systems or teams to try to insert a new piece of data into their daily lives. Finally, contract changes. It is a factor of 606 that contracts can change, can be modified, new line items or change of terms or something. And as we know, there are two main types: a contract modification, which is prospective in nature, or a change of estimates, which is a retrospective in nature. A change to SSP falls under the second category, the retrospective contract change. And RAR out of box is capable of managing that change whenever that SSP changes, whether it comes from an external source or it's maintained directly in the system. And that functionality is a big advantage to the tool itself as built by SAP. Again, moving to the fourth bullet point in the top set, the old faithful of residual estimation approach, out-of-box functionality for SAP RAR. If you would just run out of ideas or run out of options to calculate an SSP or particular line item, you have a lot of price variability or whatever else happens, and it becomes a very challenging thing to do to apply upstream, you can always fall back onto that, assuming your auditors agree, of course, and allow the tool itself to do the residual estimation approach of SSP, which is an out-of-box functionality. So in all of this, the separation of upstream systems and upstream transactional data from the revenue contract and performance obligations allows you that flexibility and allows you application of the various methods of SSP calculation as we discussed before. And Jim, back to you.
Thank you both. That was a great overview on SSP. That will end this webcast for today, but I invite everybody to visit the Bramasol.com resource center for this webcast, other webcasts focused on the Office of the CFO, and also you can download videos of our live webinars focused on revenue, compliance, and other topics for the Office of the CFO. Julio and Jacek, thank you very much for your inputs today. They were wonderful.